Hello and welcome to Pro Trader Strategies Market Commentary for Monday, October the 29th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all of that out of the way, let's get it on. It's a Monday, so not really any economic data here in the United States. Across the pond, though, we did get Great Britain's CBI industrial order expectations. Now, the CBI is a confederation of British industry. It's a survey that goes out and asks over 500 businesses what they expect for their orders. And anything above zero indicates that there is increasing volume expected. Anything below zero is that lower volume is expected. So that number was supposed to come in at come in at 9, came in at a negative 0.2. So lower volume expected for industrial orders. So not really a great sign there for Great Britain. Anyway, on to the overall markets. We've got crude oil slightly higher on the day. It's kind of right in that area that I talked about, it wanting to kind of trade between this value area high and the Fibonacci level here, the 23 retracement area. So it's kind of bouncing in there just as I had expected to kind of fill in this low volume area, kind of round that off a little bit more. We're starting to see that later on this week. We do get crude oil inventories, so that I would expect kind of to trend sideways here. We're also seeing gasoline inventories starting to rise as well. So just to keep that in mind, a lot of that has to do with the oil inventories getting converted to gas and other distillates, things of that nature. Gold futures up slightly on the day. I was really looking for this kind of break below earlier on this morning. It kind of broke below that. I thought that the bears were kind of taking control of this, but since then we have started to see this market ratchet up and get back above the 61 fib level here. So that is acting as a pretty strong support for the bulls. So the bulls are going to be trying to fight to maintain that level. I think if we settle below this fib level, we are going to go down here and test the next 50 Fibonacci retracement area in that 1250. That's where I'm kind of looking for gold to go to. Bonds, after Friday's big sell-off, we're starting to see a bit of a rebound today. It's only up 8 ticks or so, and it's right there at this magnet, which is where the most time and volume's been spent, the point of control. That's where it's going to be comfortable, and I don't see it really moving too far away from this area with the Fed talking about increasing interest rates and things of that nature going forward. Bonds just don't really have any room to the upside, and there's not a whole lot of room to the downside because it's only going to be ratcheted up by a quarter point at a crack at this point anyway, especially with the economic picture not really firing on all cylinders and giving us robust economic data. That's going to be when they start really ratcheting that interest rate hikes up to maybe 50 basis points or something like that. On to the VIX. It's back up into the double digits again, so we can hang our hat on something with the volume increasing. Some of that has to do with heading into this earnings season. A lot of the implied volatility percent is going up for a lot of these stocks. So as implied volatility goes up, VIX is going to reflect that as well. Then on to the overall markets. We've got the Dow Jones Industrial Average up 10 ticks. Again, another new historical high. To me, this is like getting a little overdone to the upside. I did expect it to kind of break out in one direction or the other with the S&Ps and things of that nature. Dow Jones has really beat the rest of the broader markets to the upside, and it just seems like it may be getting a little bit tired. That might be just because it's a Monday and there's not a whole lot of volume going on, and it's just taking a breather though too. We've got the Nasdaq off 10 points right now. It hasn't been able to gain that momentum that we've seen in the Dow. It's up in the 6,000s, but it seems like there's a bit of a rotation out of tech and into the blue chip stocks that is in the Dow. We got the E-mini S&Ps having a new historical high, but it's off on the day towards the lows of the day, down just over 2 points. Again, it just seems like it may have gotten a little bit overdone to the upside with me. So I'd like to see it break out in one direction or the other, a little bit more than what we're seeing here for my SPY straddle that I have on, that long straddle. It's just, it's really not keeping up with the move because of the decay in those options. So I need a bigger move to happen rather quickly. All right, so on to Lululemon. Lululemon's one of the trades that I had in my margin account. Didn't have this one in my IRA. It was a long straddle also, so following my rules, low implied volatility, as you can see. I got the directionality where it moves outside of what one would expect. It was kind of calming down, remember, and I talked about it wanting to kind of break out either one direction or the other. If it got much below this area, I thought that it would kind of migrate down to where the most volume's traded. So that was one directional move, and it's found resistance here, and if it broke above that area, it expected it to kind of make an outpaced move, which is what happened. So in that Lululemon trade, I had on the November 60 straddle, so actually long the 60 straddle. So I was both long the calls and the puts at the 60 strike. And for that trade, I originally had paid right around $4 for it. Yeah, I paid $4.05 for it. I got out for $5.46. So that was an increase of about 35% the amount that I paid out for that. So that's right in line with my rules to get out on the exit strategy of that type of trade. So when I was able to meet that expectation, then that's when I decided to get out. Then on to Nike. This is a trade that I had both in my IRA and in my margin account. Same strikes, very similar situation. And with that being said, let me find where is my Nike trade here. So the Nike trade I had on the November, I was long the 47.5 calls and then short the 55 calls to create that long call spread. Now, when I talked about putting this trade on, I said I don't really necessarily expect it to get all the way up there to this 55 area, but I'm just looking to take a 50% of my max profit on that trade. And if you remember originally with this Nike trade, I did bought the 47.5 calls, sold the 55 calls for $3.84 is what I paid for that. So it's $7 wide, $7.50 wide spread. So when you pay $3.80, the max profit on that would have been another $3 and basically 70 cents, right? So max profit $3.70. What I look to do is take 50% of that. That gives me about $1.80-ish or something like that. So add that on to the original debit that I paid of $3.84. I was able to get out for $5.60 in both my margin account and in my IRA. So got in for the same price and got out for the same price on the Nike trade. So that's all I've done is kind of cleaned up my positions there, took off a couple of winners. It's always nice for a Monday to get that going for me. I got a couple other ones that I'm looking at, but nothing really jumping out at me. Like I said, we're heading into the thick of earnings season, so I want to save margin for those trades. That's when we know we're going to get this volatility crush like you see happening in Nike every time they have an earnings. The best thing about that is you can be directionally wrong and still make money. I talked about this with a couple of those earlier earnings trades. I had 4 trades on, all of them directionally against me, but because of this volatility crush and that premium coming out, even though I was directionally wrong, I was able to come out profitable in all of those trades. So that's what we look to do when we're doing these earnings trades. So check it out at protraderstrategies.com. Watch those videos. It's like 8 videos on my favorite trades for trade setups for earnings, and I'll be implementing those according to those rules for different earnings I see. So I'll be tweeting that out on Twitter also, like, hey, I'm doing a straddle in XYZ, or I'm doing long calls in XYZ. You'll know exactly, or actually I would not be saying long calls, sorry about that, doing short calls in XYZ or short puts in XYZ. You'll know the trade location because you've watched those videos, so that's really important to do that. I don't want to blast that out that necessarily everybody, but you guys who are taking advantage of these daily market commentaries want to make sure you're in the know. All right, so go to protraderstrategies.com, sign up for that, and Friday's calendar, we're going to be doing the put calendar in there. So going to go through all my rules on setting something up like that, because that's a great strategy to implement right after the earnings goes through and we lose all that volatility. We can take advantage of this expansion in volatility heading into the earnings. So that's the important thing here. So we'll be able to exploit some of that volatility expansion, and I'll show you how to take advantage of that. All right, so go to protraderstrategies.com, and if you can't take that, take it easy.